everyone, and welcome to another episode of Financially Focused. I'm Dennise Williams, your guide through the maze of financial strategies, and we are going to help bring some clarity to you so that not only can you speak with confidence to your banker, your insurance agent, your financial coach, the people who are on the team that you're building to help you create generational wealth. And so we're going to deep dive into the world of insurance, and we're going to talk about how to use it as a tool to build wealth over your lifetime. And this is all about building up the financial destiny that you want. Income, savings, protection, mindset. These are the legs of a strong financial table, right? So it includes the different ways of cash flow, your mindset, the protection of your family, and how to eliminate debt. So on Financially Focused, we look at these different topics. And if you sort of want something more concise, visit our website, financiallyfocusedmedia.com. Access your free financial independence course. It will take you through building up your plan in all of this. But we're going to drill down in this conversation. So we're so happy to have Tennien Black, our insurance advisor. How are you?
I am fine, thank you. How are you?
I'm great. So we want to use insurance as a tool to build wealth. Now here's the challenge. A lot of people don't like insurance. When I get insurance, I'm going to die. My children are going to know everything about me. And then, because sometimes in the media, people use insurance not in a positive way. It gets a bad rap. But we need it. Yeah? And we want to look at how it can protect your family over the lifetime. And that includes from they're a baby to retirement planning. Now, if you're carrying a client from baby days to retirement planning, how does that work for you?
Oh, that is perfect.
Yeah.
So enters mom and dad.
Yes.
With baby.
Yes.
A month old.
Okay.
Policy has started.
Okay.
So as an advisor, you become a part of that family, and you'd be a part of the birthdays, you'd be a part of the funerals, you'll be a part of the concerts and the different things. So the plan is at a month is to start college savings.
All right.
Right? And of course, the parents would already be covered.
Okay.
Because they're the ones who have the income that the baby is depending on.
Right.
The baby does not need so much of an insurance because he or she doesn't have any dependents.
Right.
So the focus would be for investment.
Okay, so let's start right there. So we're saying that when the baby is 1 month old, we're really looking at an investment.
Yes.
So the parents would have to be covered because, of course, they are the ones that's caretaking the baby.
And they have an income to protect.
But the baby is now, we're building slowly investment. Okay. Sometimes life throws us curveballs. Sometimes those same parents no longer have a 9 to 5. So we're just going to take time and go through that. But, okay, so now we're going to jump from having the baby. If the child, say by 5 years old, the child has a special need, a disability, how does insurance now, how do you have this new conversation with the parents?
All right, so the new conversation with the parents would be that you would focus on the investment.
Okay.
But also because you'll need available cash, not only for emergency, but just to build that financial independence of that child who will one day become an adult.
Correct.
Additionally, the parents would factor that there's a new variable, that the child has special needs.
Correct.
And what that means is that the child will have special need for care.
Yes.
Should something happen. So the parents now has to have a very attractive life insurance.
So you're
in
not
place.
just assessing the child's life insurance need, you are assessing the parent's life insurance. Okay.
Because in that way you are securing the income that will support that child for the rest of his life.
Okay, so it's a dual thing.
Yes.
All right. So for special needs, we're saying to parents, assess the insurance in terms of investment, assess the parents in terms of their income. Are we adding anything else? Critical illness, disability insurance?
Critical illness, retirement planning, all of that, because you're looking at it for the long run. So what happens when the parents get a little older, and let's say the parents...
Well, we jumped too far. So we're at the baby's 5.
Right.
Okay. So now we're looking at from 5 to 10. So we're back again. The child is 10 years old. Whether or not the child has special needs, but the parents are 5 years older. What are the conversations we're having?
So being my clients,
Yes.
I would have been speaking to them every year.
Okay.
Because every year they would have gotten older.
Yes.
We're looking at inflation.
Yes.
We're looking at plans change.
Right.
So I would have been speaking with them every year, and with their permission, those insurance portfolios would have been adjusted.
Okay, so we're making sure we follow and track inflation so that the insurance policy doesn't lose value.
Right.
I did speak to someone over the weekend who was very angry that her parents had not kept up with inflation. So by the time the parent, she was to get the insurance, it had very little value, and she felt cheated by the insurance agent. How do you answer that?
Well, the insurance agent definitely had a responsibility to follow up.
Okay.
But it is a conversation, and it is an agreement.
Right.
So I would point out inflation. I would point out setting aside extra cash in terms of cash that you can, as well as adjusting your insurance coverage.
Right.
Let's say the responsibility on the insurance agency where he or she fell short. That is definitely not acceptable.
Right.
But let's say also that the parents would have been a part of the conversation and should at some point, having got that information, would have made the adjustments to ensure that the child has an attractive, because a lot of persons don't believe in wealth creation or generational wealth.
Right.
They think that I have survived, they could survive too.
Yes.
But that's not how it should be. The Bible encourages us to leave heritage for our children.
Okay.
And that is why some cultures you see generational wealth, because they're looking at it. Not only are they setting aside assets, but they are minimizing expenses. They're taking care of their families so that you have that.
Okay, so now the child, we're going from 5 to 10, 10 to 15. Maybe the child and the parents maybe having some, new challenges. Let's say your child is 15 years old, but you, the parent, have transitioned from a 9-to-5 job to being an entrepreneur. Okay? How does that change your investment, your retirement, the critical illness, the disability, this insurance portfolio that you are building to create generational wealth? What happens when you are no longer in the system for the 9-to-5?
That is a great part to look at it. So remember that I met them before the baby was born.
Yes, right.
And they would have started something for the baby.
Yes.
Right.
That baby is now 15.
That baby is now 15. So what you're looking at is an investment for the baby benefiting from compound interest.
Okay.
So at that point, capital should be available from the baby's investment alone that could help with the entrepreneurial part of it.
Okay.
It could be used to expand the business. It could be used to buy input for the business, as well as their own portfolio in terms of investment, because most insurance policies has investment attached to it.
Okay.
And these investments grow very attractively. There are similar to what you call unit trusts.
Okay.
They grow attractively. You can diversify, you can mix and match and rearrange, you can adjust, you can do lump sums, you can do planned payments and so on. So what you have is over time, that investment could be benefiting from compound interest. They would have forgotten that they had that investment in the first place, and now is a good time to discover, oh, I have a policy with money on it.
Right.
And it becomes very useful at 15 years.
All right. Wow. So now the parents are older, jumping from age 15 to 20. The parents are older, 20 years older than when you met them. The child now at 20, you know, you're sending them off into the world. How does that change insurance? Because is it that the parents no longer need to carry insurance for their child, but get the child to have their own insurance?
Great. So now the child is 20. More than likely would be around the first year of college.
Okay.
So let's say it's one child.
Yes.
The parents at home would have a little bit more time to do things. They're not dropping off to school every morning again. They're not packing lunches and so on. So the policy that started out, or the plan that started out as a baby, has now matured and is now funding college.
So in this perfect insurance scenario, the pressure to pay for insurance is not so much because you had started when the baby was a month.
Yes.
Okay.
So there is enough and leftovers to send the baby to college.
Right.
At this point, you can also pass the plan over into the adult's ownership.
Okay.
So he has now started his own portfolio with asset to begin with.
So you're saying that you can contact your insurance agent and say, I have this portfolio for my child. I'm transferring the ownership to the child? Okay.
And it can be automatic as well. So as part of the agreement, at the outset, you can tell us that at age 18, we want you to vest it into the ownership of the child. And that can be arranged.
Okay. Now, there's some uncomfortable parts of life. We're looking at divorce and death. How does insurance help someone to start over, when they emotionally, the separation feels like they're at ground zero? What do you say?
Well, that is an opportunity for you to reassess and reevaluate your insurance portfolio.
Okay.
So in the case of divorce,
yes,
one of the first things that you look at is how will the child, if there's a child, be provided for.
Right. But this child is 20, so
the child is 20.
They're on their own.
All right. So the other thing to look at is beneficiaries.
Okay.
So when things were great and happy, you would have been my beneficiary and I would have been your beneficiary, but we're not together anymore, so
I done with you.
All right. So now is a good time for you to assess who the beneficiaries are.
Okay, so let's revisit that.
Yeah. Let's say it's amicable, then you can decide how that goes. Right.
Yeah.
If it's not amicable, then it's definitely time to look at the beneficiaries. Anyone can be beneficiary. It can be a friend. It can be...
Can I leave it to my church?
It can be a church.
Or what about like a foundation that I care about?
It can be a foundation. It can be a company.
Yeah.
Any person, and a company is a person, one or more persons can be beneficiaries on your policy.
Okay, so if I happen to have a death or a divorce, I can revisit my insurance and change the beneficiary.
Yes. And the other thing to look at also in the case of a divorce is that you are now assessing your income.
Yes.
So let's say you shared a home, the mortgage is split, the utilities are split, the expenses are split straight down. When there's a divorce, then you have to factor how does the expenses...
So you have to reevaluate.
You have to reevaluate.
Okay, all right. So for entrepreneurship, how does the insurance agent, help? Because we're looking at the life cycle. How do you help me with entrepreneurship?
For entrepreneurship, it is another level of planning. Normally when you are employed somewhere, There are certain benefits that they take care of. As an entrepreneur, you have to take care of your own benefits.
Right.
If it's a partnership, you'd also want to be looking at, okay, so you're funding 50% of the capital in this business, I'm funding 50%. If I die, where does that 50% come from?
Right.
If I become incapacitated, where does that 50% come from? Also, where does it leave my family who was depending on my income from the business if I die or if you die?
Okay. So when I go into entrepreneurship, insurance can help protect my interest in the business.
Yes.
What about retirement planning?
Retirement planning is the sweetest part.
Okay.
It is one of the parts of my job that I enjoy.
Okay.
So picture elderly couple around 60, 65, and they walk in and they say, oh, I'm just updating my age to let you know that I'm still alive so that I can send my pension payments to my account. And this couple, children are adults, so they're home alone. So they are young again.
Right.
And they're just enjoying life. The reason they're enjoying life is because 30, 40 years ago, they started their retirement planning.
Right.
They are setting aside small amount of money, but small amounts of money set aside over a long period of time becomes a lot of money.
Right.
Especially with compounded interest, especially with discipline.
Awesome.
So they're now reaping the rewards of their discipline. Attached to that, they knew that they would have been getting older, and they would have set aside something for their health care.
Okay.
So at this point, they're not worrying about anything.
Yes.
And because they're not worrying about anything, it also improves their health.
Ah.
No worry means better health.
Okay.
Right?
Yeah.
No worry means more time to do what you enjoy.
Right.
And they're just at the prime of their life.
Awesome.
And that's like icing on the cake for me.
Okay. So, this was awesome. Tennien, we went through the life cycle. We started when the baby was 1 month old and we went all the way to retirement. Thank you so much for sharing your insights on insurance and the life cycle and creating wealth and generational wealth with us.
It was my pleasure.
All right, thank you. Now here on Financially Focused, we're all about empowering you to take control of your financial destiny by building a strong financial table that covers 4 main areas: income, savings, protection, and mindset. Income, of course, is the various ways you earn cash flow. Savings is the foundation for your short and long-term dreams and goals. Mindset is how you build your emotional and wellness capabilities to continue to grow wealth. And we define protection as eliminating debt over on this side and eliminating risk on this side with insurance. Now, we are looking at your life cycle, and we're looking at how you can protect your family when they arrive. Now, we're not leaving out retirement planning, and we acknowledge that life throws curveballs such as disability, death, divorce. And if you transition from the 9 to 5 to become an entrepreneur, we looked at how insurance helps us with that. Now, if you're looking for financial independence, be sure to visit our website, financiallyfocusedmedia.com, for our free financial independence course. My name is Dennise Williams. Thank you for joining us. I'll see you next time.